Good afternoon, everyone. Apologies for this delay. I know it's not cool, but unfortunately, I was having some technical issues. Let's
No
see
problem.
who we've got here. Hi, David. How are you?
I'm good, Anton. How are you?
Well, I could be better off in Barbados or somewhere similar.
Yes, I know the feeling. I know the feeling.
Apart from that, ticking along, I see we've got Rob, we've got Tommy, and we've got David, and then a few people that are joining in as audience. So, good afternoon, good morning, good evening, wherever you are. Thank you very much for joining us. This is Startup Fundraising Q&A. It's our 125th session. We've been doing these for almost 4 years now, and we've had over 270,000 people join us. None of that would have happened without people like David and Rob and Tommy, who is one of our regulars. So please do feel free to show them your love and follow them on LinkedIn and Twitter and wherever they hang. On the other hand, we're here to help founders with whatever questions you may have on your fundraising journey. You see, unfortunately, over 90% of startups fail. And the top 3 reasons for that are 1, market fit, 2, running out of money, and 3, not having the right people. And hopefully that second reason is what we'll be able to help with today in terms of helping you not run out of money and not only help you survive, but hopefully we'll be able to help you thrive. We've got 3 brilliant investors on stage with us today. They're going to be here with us until 1 p.m. So if you've got any questions, the way it works is that if you are tuning in via Microsft Teams, you put your question in the chat and then we'll unmute you. If, however, you're tuning in via our live streams, whether that is Facebook or YouTube or LinkedIn or Instagram, please be aware that unfortunately we're unable to monitor your questions there. Therefore, you would need to join us live here on Microsft Teams. Most of those live streams have got the link which can take you to our call here on Microsft Teams. But nevertheless, I will, as we go along, I will double check whether that link is in all those platforms. But again, please be aware that unfortunately we're unable to monitor your questions live anywhere else but here on our Microsft Teams call. In terms of your questions today, they can be on pretty much anything to do with fundraising, whether you want to know when's the right time to go out and speak to investors, or perhaps first and foremost, if you should go for investment, and if you should you speak to an angel, a corporate, a VC, or maybe should you look at a grant or a bank loan, whatever that be. There are no wrong or right questions for that matter, and there's no need to be shy. It's a learning curve for us all. So what we're going to do now is go through some quick introductions, and then I'll probably ask my experts, my investors here, what are their biggest do's and don'ts when it comes to early stage fundraising. And hopefully that will give you time to formulate your questions and put them in the chat so that I can then ask the investors. So without further ado, my name's Anton Call. I'm an Albanian in London working with startups. Normally, right after they get investment, I embed within their teams and help them hire and keep the right people. I also do some growth advisory work with a few accelerators as well as founders. And lately, I've been helping some angels and especially family offices with their due diligence and assessment. So we can start, I guess, with David, I think, who was first, or perhaps, well, Rob's unmuted. So let's go to Rob, then David, then Tommy, please.
Yeah, hi. Good afternoon from London, or certainly the UK time zone to those in this time zone, and good day to those of you listening in wherever you may be elsewhere in the world. I'm Rob Garrett. I've spent the last 15 years working in, with, and for predominantly family business investors and family business builders, and today am a investor, participant and partner in a number of family office style syndicates and funds, mostly focused on investing in things that are positive for planetary and human health, would be a neat summary. Is there anything else
Brilliant.
you'd like me to add?
No, that is all, and that is brilliant. Thank you very much for joining us, Rob. Now, David, please, and then Tommy.
Hello, everyone. I'm David Levine. I'm an exited founder. I'm now an angel investor, but I also run an angel syndicate. More importantly, I raise money for startups from all over the world, from investors all over the world. I spend my time working alongside those businesses, going deep inside the businesses and getting that funding done. Completed 2 deals in January alone, although they didn't start in January, I should point out. I tend to focus on B2B software, and I run my Raise Like a Pro workshop series, training series, where I'm basically sharing out my playbook, just to try and help the sheer volume of startups who approach me for help, and I just don't have time to deal with them all in a fundraising mode. So that's David Levine, Raise Like a Pro.
Thank you very much, David. I think I need to steal the way you introduced yourself. Tommy. Let's see. Tommy, can you hear us? Unless Tommy joined us not via the link. That's fine. Allow mic. Okay, make a presenter. Okay.
There we go.
Can you hear us, Tommy?
I can,
Tommy,
yeah.
I guess you didn't register with the same email that I sent you. Anyway, take it away, buddy.
Yeah, so my name's Tommy Breen, and I'm a senior advisor at the Growth Stage. So we are a capital raising platform supporting businesses that are in, as the name gives away, that growth stage. So what that means is typically we work with businesses that are ready to raise a Series B round or later. So typically if they're raising $15 million or more, that's where we come in to support. And we raise that purely from institutional investors. So there is no angels or retail investors on there. It's all larger institutions, asset managers, pension funds, and people like that. But we work broadly across tech. So, B2B, consumer, kind of are flexible in that, guys. And then outside of that, I'm also a mentor at Founder Institute. So I actually do quite a lot of work with very early stage founders that might be just at ideation stage or starting to build their MVP, and trying to guide them through that process as well.
Thank you very much, Tommy. Well, you've heard them, people. We've got 3 brilliant investors with us on stage, and they're going to be here now until 1 p.m. That means there's only 48 minutes to go. So my advice would be, don't leave it for last minute to type your questions in the chat, because more often than not, we actually run out of time and are not able to take all your questions. So if you are tuning in here on Microsft Teams, it's very easy. Just type your question in the chat, anything to do with fundraising, whether you want to know how and when is the right time to raise. Perhaps, you want clarity on investor outreach, pitch deck, data rooms, valuations, equity, due diligence, or maybe grants, crowdfunding, angel, VC, and so on. Just type your question there and I will unmute you based on the order of the people that have typed their questions in the chat. If, however, you're tuning in via YouTube, LinkedIn, Facebook, Instagram. Please be aware that unfortunately we're unable to monitor your questions live there. So you would need to join us here on Microsoft Teams. I'm going to put a link or double check because I think there is a link, but if not, I'll put a link in all of those live streams so that you can join us directly here on Microsoft Teams. If, by the way, your questions today are not on fundraising, please save them for the other days and the other events we run. So we're currently doing 6 regular Q&As, 4 weekly, Mondays talent, Tuesdays product and tech, Wednesdays growth, and Thursdays fundraising. And then we do 2 monthly, which is the first Friday of each month. We do a legal Q&A, basically UK startup law, and then a finances Q&A on the 3rd Friday of each month, which is basically about your finances. But now, as we're waiting, just before we go to some of the questions that were put in the chat, I'd love to hear from our investors. What are your biggest do's and don'ts when it comes to early stage fundraising? So perhaps this time we can start with Tommy and then David and then Rob, please. Take it away, fellas.
Yeah, so I'd say the most important thing for founders at the very early stages is, first doing the work to understand, are they what's classified as a venture backable business? It's not worth your while trying to approach investors, venture capital funds, if there's just no chance they'll ever invest in you. And that requires, doing a bit of research and really looking at your business. What's the sector you're in, and what does the market look like? So what's the total addressable market? Who are the competitors, and really, is there the opportunity that this business can be worth, $1 billion or more one day? Now, when you're at the very early stage, maybe it doesn't necessarily have to get quite to $1 billion, but definitely it needs to be a business that's going to have the ability to grow in a market up to into the hundreds of millions in valuation. And the reason for that is that venture investors, they have a portfolio of startups they invest in, and they work off power law. So they need, their fund will be returned by 20% or less of the actual investments in their portfolio. So every company they look at, it needs to have the ability, if it works, and they get it off the ground, and it actually gets demand, they get customers, that business really can scale, because they need just a small number of those businesses to get to huge valuations. So they won't invest in a business where they look at it and say, yes, it might be a great business, might be really good for you as a founder, it could be worth, single digit millions, tens of millions, but for them, even if it's a success, it's capped at how big it can get. So trying to understand, really, is your business right for VCs first before you even start thinking about approaching them, is really, really important. And if you do get to a point where you think, okay, it's probably not going to get to that scale, that doesn't mean you can't get other investors. There are angel investors out there that will look at businesses that don't necessarily need to get to that scale. Similarly, there's some family offices, and they like to invest in businesses where they have something they can offer beyond cash, or they may have a network. They may be able to introduce you to potential customers, or maybe they built a similar business and can give you advice. So all those things, then they could be happy if the business is being valued at $1 million or 2 million now, and if it can get to being worth 10, 15, 20 million, then that's a really good return for them. But it's just trying to do that, and it can be very hard. But I would say, before wasting your time going out to venture investors, making sure you understand, do you have a business idea that they could actually invest in and get the return they require.
Thank you very much, Tommy. Yes, David.
So I think there are 2 main things I would look at. So the first thing is, like Tommy has said, it's all about the market. So figure out, are you venture backable? So are you disrupting a really, really large market? And the way you do that is the exact opposite way of 98% of the slides I see. So rather than going top down, which is some analyst somewhere has said this market is worth 62 trillion and we're going to grab 3% of that market, those type of analyses are absolutely pointless. They're not credible. They're not authoritative. They're meaningless, and they don't, just unhelpful, and they come across as quite naive. Instead, you do it bottom up. So identify your ICP, your ideal customer persona, your buyer. Identify how many of them there are in the world, and I really mean the entire world. And identify how much you're going to charge them, and that is your TAM, your total addressable market. Then, of course, nobody has ever got their TAM in before. So you come up with some type of segmentation strategy. could be English-speaking countries, it could be a particular subsegment of your target market, or it could be particular cohort where you have a distribution advantage, where you have a unfair advantage in actually reaching out and going into those here. That's your SAM, that's your serviceable addressable market. And then your SOM is some typically single-digit percentage share of your SAM. So TAM is every single customer in the entire wide world, from Norwich, Tel Aviv to Dubai to New Zealand, who could ever use your platform, even in adjacent markets, and how much you're going to charge them. Your SAM is some sensible segmentation strategy applied against that TAM, and your SOM is some typically single-digit share of that. And that needs to be, that SOM number, that needs to be, a couple $100 million at least, I would say, these days for a venture backable business. So that's point number one. Make sure your market is big enough. Point number two, research your investor. So whether you're reaching out to VCs, angels, angel syndicates, all of which I deal with regularly on a daily basis, make sure that you're right for them. Make sure the segment is correct. Make sure the traction level is correct. Make sure the founder mix is correct. Some investors only want to see dual founders. So if you're a sole founder, don't bother wasting your time. Some have geographic constraints where they can invest. Some need returns in 3 years because the fund needs to return in 3 years, and you're a deep tech business that won't return for 5 years. Make sure you do your research, and make sure when you've done your research and you've identified an investor, tell them in that cold outreach why that you're reaching out to them, why they should care about you. Fundamentally, on the question of cold outreach, 97% of deals are done via warm networks. So whilst cold outreach can work, it's a lot harder. But anyway, my 2 points are: make sure you're building, disrupting in the right market, and build that market from the bottom up. Number two, when you're reaching out to an investor, research them to death so you're not wasting their time, and more importantly, you're not wasting your time, and tell them why they should care about you.
Good on. Thank you very much, David. Rob, what are your biggest do's and don'ts?
So I think I would like to sort of rehash and recover a couple of points that both Tommy and David have made. I think they've made very salient points, and just to condense it down, my biggest do would be: don't ask for money, do ask for advice. So coming back to the point that David was just making about researching the investor, I think it's far more compelling if you go to the investor and say, I've identified that you're a subject matter expert in this domain. And look, particularly if one is talking about family offices where they have come from a tangible family business, which is the true and proper definition, in my opinion, of family offices, rather than those who are just managers of money for families, and quite often have become managers of money for people who are financial creators of wealth, not people who have built a generational or a product business. But let's say, as an apocryphal example, you go to a family that's built its wealth in farming, and you've got a product that's in agri-tech. Address them in a way that shows that you've researched what they're good at, how they've created that wealth, where they have existing operating businesses. And rather than going and saying, I see you as a cow that I can milk and give me your money, actually go and say, can I get your advice? I've got this great idea that I'm working on. I think you'd be the perfect ally to help me build it. I'd really love your advice, because more often than not, those investors want to be valued. They want to bring value beyond just their capital to a business. So that would be my greatest do, is do ask for advice. And then the greatest don't, I probably get, I don't know, somewhere approaching 100 emails a week, which are completely cold, stating, as David just addressed it, the SAM, the SOM, etc., which is largely irrelevant. They've told me that they've got an absolute moonshot, and then they finish off with, we're raising $5 million with a minimum check of 500K, and we're closing in a month. First of all, cold emails go in the bin. So work your network intensively to get the warm referral. Spend more time working on finding out and working out how you can get to someone who knows the person that you've identified is that person you really want to go to for advice. And obviously it's a numbers game as well, so you've got to talk to a lot of people, but there won't just be one person, you know, coming back to my sort of apocryphal example, who is good at agriculture and is in a domain that can help you to build your agri-tech, if that's what you're in. So work on the warm referral and stop cold emails, and never, ever, ever buy lists from someone of names of people that you've never met, because they're worthless. Just organically build your own network.
That is brilliant. Thank you very much to all three of you. Now, a quick reset of the conversation. I see some new people that have tuned in. And then Peter asked a question in the chat. So I'm going to, hopefully you're still here, Peter. So I'm going to unmute you and give you the mic if you like. Where are we? So for those of you that have just joined, by the way, this is Startup Fundraising Q&A. It's our 125th session. We do these to help startups with whatever questions you may have when it comes to your fundraising journey. There are no wrong or right questions for that matter, so please don't be shy. It's a learning curve for us all. All you have to do is raise your, well, not raise your hand, put your question in the chat first here on Microsft Teams, and then I will unmute you and you'll have the floor and you can ask the question to our panelists. If you're tuning in via Facebook, YouTube, LinkedIn, Instagram, please be aware that unfortunately we're unable to monitor your questions there. There's a link now on all of those platforms, on all of those live streams, where you can click and join us here directly on Microsft Teams. And also, if your questions are not on fundraising, please keep them for the other sessions we run. Monday's talent, Tuesday's product and tech, Wednesday's growth, Thursday's fundraising. Second Friday of each month, it's legal, and third Friday of each month, it's finances. They're all 12 to 1 p.m. UK time, and you can RSVP via our site, startup-to-scaleup.club. Actually, best thing to do is to click on the WhatsApp icon there, where you'll be able to join our group and get alerts for all future rooms. We've had 270,000 people that have joined us so far in these 4 years, but because we've recently changed platforms, I guess we need all the help we can get to spread the word, so please feel free to do so. Now, Peter, are you okay to talk? I've unmuted you. Can you hear me? Okay, if Peter, I believe you're not, but let me just double check. Peter's saying he's muted. Where is it? Okay, let me try it again. No, hang on, Peter. Wait. Disable cam. No, Peter, you just need to unmute yourself. So click on the mic. Just click on the screen. You'll see a mic.
Here we are.
Yes, there you go. Yes, we can. Take it away, please. Introduce yourself and then quickly ask your question. Perhaps you can tell us a little bit about your startup. Let's try and do that within a minute. And also, if my investors can try and keep their answers to a minute, I would really appreciate that, because there's quite a few questions. Take it away, Peter.
Right. I actually have asked 3 questions, but we'll come back to that in a minute. I'm Peter Parker. I have a company that does biological tracking and tracing of material, mainly for fertility clinics that involve going through cryo storage. And we have the unfair advantage of being able to read the labels that we have created inside what are called dewars in order to be able to audit and, well, basically audit is the main thing. Normally an audit takes about a week on one tank, and a clinic is likely to have 20 or 30 tanks or more, and we can reduce that to seconds. And there's lots of other things, but that's the basic background. I have three questions, which is how long does it take to get from starting fundraising to actually get to fundraising?
Let's focus on that first, Peter.
Okay.
And then if we have time, we'll definitely go to the others. Is that all right?
That is fine. We'll do them one at a time. I'll deal with this one, and then we'll come to the next when you let me in.
Good man. Thank you very much. This time, let's start with Rob, then David, then Tommy, please. Your 1 minute of glory starts now, Rob.
Not to be too facetious, Peter, in answering this, but my answer to it would be take the rule of thirds. So if you ever see on a deck from a potential investee company that they're estimating that their company could be worth something in terms of the serviceable addressable market and other metrics, you can probably slash that by a third. And the inverse of that for fundraising is it's probably going to take 2/3 as long a time as you ever thought to fundraise. And so the simple answer, I think another question that you asked, which is very linked, when is the right time to start fundraising? It's always the right time to be fundraising before you need money. Never leave it until you think you're going to run out of money or you can see the end of the tunnel and the light at the end of the tunnel has started to disappear. So you need to have a plan. And also, in reality, fundraising is a full-time endeavor. So every conversation needs to be about the potential to fundraise. You are consistently building your network. You are consistently building the relationships. And I think this addresses another question that I've seen addressed in the chat, which is, if it's a numbers game, how do you get to the numbers?
That's my question.
Okay. You need to treat every conversation you have with someone like the path to a potential warm referral. And you should always go into every single interaction that you have with someone as a startup founder, as a business builder, with a notion that out of this meeting, I am going to get something. So whether that is, I'm going to get a direct lead to funding, this person could be my funder, or it's going to be, I know that you're not my funder, but who do you know that I could go and have a coffee with next, so that they've referred you to someone, and consistently making those linkages. And so, yeah, just to recap, the short answer is it always takes 2/3 as longer than you think it's going to take, and start before you need to start, and consistently treat every endeavor like a fundraising conversation, because when you need to fundraise, if you've set the conditions to perfect that fundraise, you will be in a better place.
Okay, so but you've also answered the second question, which was yeah,
Peter,
the numbers.
Let's wait. Let's
the
wait
numbers
on that,
aspect, which we're basically saying it's a just keep going at it, just keep going to the meetings.
Yeah.
Let's wait for the second question. David, it's your turn, and if you would like to close your camera, perhaps that's best, and let's keep it audio only. Thank you. So your minute of glory starts now, David.
So the question was, how long does it take to do a round? How long's a piece of string? I would say always budget a minimum of 4 months. It will, as the previous speaker said, always take you longer. And I think that's pretty much everything in your startup life. Everything will be harder than you think and will take you longer than you think. More important, I think, are the things to look at that will help drive speed. So get the right messaging correct. The number of businesses who don't even articulate what it is they do, how big the market is, like I mentioned, build that ground up, not top down, why you're the right team to do this. Any traction is your evidence of your validation of your startup hypothesis. And really focus in, this is such a big miss, on your go-to-market motion. So how are you actually going to go to market? It's all very well to articulate a super granular bottom-up market size, and it's a huge market that you're disrupting, and it looks nice and it's all great and stuff. But how are you actually going to acquire your customers? Who's the buyer? Where do they live? Where do they work? Where do they talk? Who do they talk to? How do they buy? What's their procurement process? Can they whip out a credit card? Do they have to go through a whole procurement committee? So I think it's really important to identify what are those things that get in the way. Complexity kills a raise if you have a complex arrangement of, you know, a top co and the parent co, and your IP is in this business, or that will kill it. Annoying pref stacks on your cap table, right? If you've got a previous investor and they've got prefs in there, that will always slow things up. University spin outs, if you've got university cap table, typically it's too much off the cap table, that will slow things off, slow things down. If you have a previous employee no longer with the business, there's a legal issue hanging over your head. Just tidy up all the bits that need to be tidied up. You know, make sure that any skeletons that are hiding in the cupboard, you pull them out from the cupboard and you bury them under 6 foot of concrete so they never see the light of day ever again. They're the things that get in the way of that fundraise.
Okay, that sounds sensible to me.
Thank you very much, Peter. Tommy, your minute of glory starts now.
Yeah, I won't, in the interest of time, there's not a lot to add. I think the guys have covered a lot of, you know, the fundraising in terms of length of time already. The important bits that have been said, I'd say, is just, you know, get organized in advance. You know, you're always fundraising, so you should always have your deck ready. So have your core deck done, make it sharp, snappy, easy to read and understand, and have it always ready to go, because you never know when you might bump into someone and they might just say, oh, give us a look at a deck or something. So always have that ready to go, and then you update it. So a lot of the work is in the heavy lifting, doing that background stuff and having your materials ready and prepared to go to investors. And then just, you know, whilst you're doing it, just be, you know, conscious that fundraising is, you know, basically a full-time job in itself. So whenever you are actively out there for a few months trying to have meetings, to be prepared for that, because what's going to happen is investors will want to talk to you, and while that's going on, you can let slip the business. And, you know, if you're going through a due diligence process, the investor says, oh, well, last 3 months things have started to taper a bit or slow down, and that's because you've not been able to focus on the business while fundraising, that can kind of become a problem. So I would just make sure that through the process you're really trying to balance. It's really tiring, it's tough, but, you know, you got to focus on running the business at the same time. So just prepare yourself for that as well.
Thank you very much, Simon. Huge thanks to all three of you. That was pure gold. And Peter, if I quickly may go through 4 things that go in line with what the investors have said, and Rob, I think, touched on that first. One of the first things I learned about the investment world is that if you ask an investor for money, you may get advice. And if you ask them for advice, you may get money. That's number 1. Number 2, their view was pretty clear. How long is a piece of string? Number 3, if you do want actual numbers, it used to be a case of around 6 months for the right business. It also used to be a case of wanting to kind of have a bit of a runway of around 12 to 18 months. What I'm seeing now, it's a much longer sprint. What I'm seeing now, it's at least 12 to 18 months to raise, most businesses anyway. And also in terms of runway, startups needing to look at 18 to 24 months. I hope that helped, and we'll now go on to the others, but please do feel free to join us again. I'd love to hear on your progress.
Okay, thanks.
Perfect. Rightio, let's quickly go to some other questions. So who we've got, the next one is Chris. Let's see if we can unmute Chris quickly. That is a question on family offices. Bear with me. Peter, would you mind muting, please? Perfect. Okay, so where is Chris? Allow mic. Chris, I believe you have now been unmuted. Would you mind click on your mic and introduce yourself quickly and your startup, please, and then ask the question you put in the chat. Thank you.
So I think my name says Chris, but this is actually Christina, the founder of Race2.
Ah, here we go.
Yeah.
Thank you very much. It's good to see you again, or hear from you again, Christina. Take
Hi.
it away, please.
Nice to be here. So we are still technically pre-seed fundraising. We've gotten some pre-sales, so have secured some of those contracts for companies to use our risk management side of our software. Our company is a tech sports startup, or sports tech startup. We integrate all of the endurance racing, so marathon, triathlons, virtual racing, in-person time and risk management all into one platform for race production companies to increase revenue, reduce guests on the course and for users who have a virtual community prior to race day. So my question is about family offices. I have never paid for a list, but there's a lot of lists going around, different venture studios, different people with vendors that service startups. I've gotten maybe 3 lists, like just Google Sheets, Excel files of lists of contacts at family offices. I generally don't do just the super cold emails. I try to cultivate relationships prior to, but I'm a little confused on the best way to approach family offices. My understanding is family offices are more network-based. They don't tend to go to as many startup events. I haven't seen as many representatives from family offices out there in the community as venture funds, or even, you know, I have contact with our angel investors through the industry that we're in. So my question is really, what's the best way to approach family offices? If there's a way I can utilize and leverage that list, or if I should just push the list aside and go at it another way.
Thank you very much, Chris. Just before I go to the investors, a couple of things worth mentioning. In my experience, actually, especially for early stage, it's really nice if you can get to family offices, but because they're so bloody hard to get to, I personally would just focus on angels. That would be my advice. Secondly, there's the likes of Valuations and a few other platforms that you can pay a fee, and you can find details of angels and VCs and often family offices too. But again, it depends who you go after. They can cost quite a bit. In London, for example, if you are based in London, you can go to the City of London and you can use their license, i.e. you can check through in their offices at things like Valuations and I think another platform that they have. And maybe, if I remember correctly, did you say you, oh my God, I'm sorry, was it Arizona, Miami? I can't remember, Christina. Where is it you're based?
I'm based in Miami, Florida,
Miami,
in the US.
yeah, exactly. Sorry. So perhaps there's a way there that you can access some kind of platform. But again, in my experience, because they're so hard to get, you probably should focus on something that you can get better results. But anyway, I'd love to hear from the panel. So maybe we can start with Rob this time, since he's got more probably experience than us in terms of family offices. Rob, and then Tommy, and then David, please, fellas.
Yeah, okay, Chris, I'll try and address my response to your particular domain of interest and expertise where you're building, but I will also try and make it generic for those people who are in different domains. So there were a couple of things, and I'm just trying to remind myself of them. How do you approach family offices? You know, how do you leverage potentially on those lists? And please come back to me if there's something else I've missed. I think the critical, look, not to rehash my previous answer, but if you take the adage of and what Anton reiterated is, if you go asking for advice, you may receive money. If you go asking for money, you may receive advice. With that, it all comes down to the research. So you've got the benefit of having been provided with this list, and I happen to have seen one earlier today. Another person, you know, clearly providing clickbait for the LinkedIn glitterati by saying, I've got a list of 50 or 100 or 200 family offices that I want to share with you. Comment below and I'll share it with you. They're obviously database building their own database of people that they may be able to do through that. So keep your eyes open to that you've provided your data to them and that data has a value. But if you've got this list of 50 family offices, you then need to put in the groundwork and try and work out, you know, on that list of family offices, the data that you have got. What do you have? Do you have the data of an employed executive, or do you have the data of potentially a family member who is a related party to the ultimate beneficial owner and the decision maker? Even in certain family offices, you know, the ultimate beneficial owner has directly mandated that they are not in the decision making process for investment. they have set up a family office so that it is a separation of powers from the capital. So they have employed executives, employed senior professionals from a variety of domains. Invariably, they've come from some form of investment banking, financial services, asset management, sometimes from senior sort of financial services consulting like McKinsey, which means that invariably in family offices, the executives that you will deal with, you will get a fairly standardized and generic approach to the way that they look at and analyze investment. So within your analysis, you really need to try and find and appeal to who are the family offices, if you've got that list, who invest in sports and are interested in the sports domain. Is there someone, either a member of the owning family or families, or a member of the executive team who is very into that kind of, outward bound endurance sport that you're targeting? Because if you go to them with that adage, that sage, hopefully piece of advice that I gave, which is ask for advice, not for money, and say, look, I'm building in this space. What do you think? How can you help me? Who would you advise that I go and talk to, etc.? And that's going to resonate with someone who likes that domain, spends their spare time, running endurance races and the like as well. The other thing that I would say in terms of how to reach people is, a lot of these people that are employed by family offices have in a previous life been their trusted advisors. Family offices, by notion of the fact that they are sort of independent money management vehicles for wealthy families, cannot survive. They don't, generally speaking, unless they get to absolutely massive scale. And then they become very, very large multi-family offices, the likes of Iconic, which started out on the foundations of managing Mark Zuckerberg's money and now manages money for a huge number of tech entrepreneurs and serial entrepreneurs globally. But they cannot survive without professional advisors. So another route to them is going and becoming good friends with the lawyers who provide the private client advice, the tax advice, or have done the transactional advice. Go and find out which firms of lawyers have done deals in the space of endurance sports or domains where you want to be, and say, look, you may have done deals at hundreds of millions, but I'm just a little minnow at this stage, but I dream of being that hundreds of millions business. Can you give me some advice? Now, they're not going to be at liberty to, say, yes, here's my client, but they might mention it offhand to their client because they spend a lot of time with their client. So, build your relationships with professional advisors and see how they can help you. Anyway, I think I've spoken for long enough, and I'm sure the other two, Tommy and David, will have some sage nuggets of advice to add to that.
Thank you very much, Rob. Yes, I think Tommy can go first, and then David, please.
Yeah, thanks. That was some pretty good advice there, and I've not a lot to add. Just, the list that you have, if you have it, lots of people have it, and probably the people on that are getting tons of emails now because of it. So just, something I always talk about, just to add on to some of the stuff Rob said, is what you do have is you have a list of names of people, and you can go and find them on LinkedIn, you can find them on Twitter, wherever they are, and you can do that research Rob talked about to try and identify, if you can see stuff that they post about on LinkedIn, or they post about doing endurance events, or tweet about it, and follow them on both platforms and start engaging with anything they post, so liking, commenting, and they get familiar with your name, and try and localize it as well. So, I know in London there's, people in the VC tech community that organize monthly runs for people that are working in venture or founders to turn up to see if there's stuff like that locally in Miami, where the relevant communities are organizing, runs and stuff, because if there's investors going to those things, they'll definitely be interested in looking at something like this. So I'd say just, be tactful with the list, use it to go and find these people online, start following them, and identify the ones, as Rob said, that you actually would have an interest in this kind of area. And they're the ones that you want to then engage with online, and then try and, reach out to them. And, as was said already as well, ask for advice. You may get investment. So start by just, saying to them, hey, look, I've got this startup in this space. I know you kind of like running or cycling or whatever. So, you know, if it's okay, I'd like to just start sending you some quarterly updates on, you know, how we're progressing with the business, not asking for money, but just so they get familiar with the business and the KPIs and how you're executing. So then when it comes to actually raising money in a little bit of time, they'll actually be familiar with you, the business and things like that. So that'd be my advice on top of everything Rob said.
Thank you very much, Tommy. David, any thoughts on this?
So not a huge amount to add to anybody else. I mean, look, as somebody who spends a huge amount of time on LinkedIn, it is my main marketing channel. I understand why people share lists. They get a huge amount of engagement. Most of the time, these lists are nonsense. They are very, very old. They're out of date. And even if it wasn't out of date and it wasn't very old, can you imagine being an investor on that list? I mean, what does your inbox look like? It's just crazy. In fact, what you can do is really take advantage of the opportunity. So get yourself above everybody else, you know, get yourself above the fold. And that is by engaging with investors. Most investors are somewhat human and, you know, they have a degree of vanity like we all have. And get onto their posts, engage, talk to them, get onto their x.com, talking about other things. Make it clear to them that the relationship you're trying to build isn't just transactional, that there's a human interest there. Give them a compelling reason. Ask them for advice. You know, the superpower already mentioned that so few founders do was just stick things in the newsletter. You know, don't make it big. Don't write an essay each time. Decide on what your North Star metrics are. Communicate them to investors with an unsubscribe link. Right? Make sure that you can track that over time. And one of the fastest deals I ever did was with a founder who we got him to build out his this newsletter of his traction, of his key metrics. And over time, the investors we were targeting just had to keep the back of their head that so they could see that there was growth there, because they got a monthly newsletter which had like 3 or 4 lines and there were the key metrics. So that's what I would do in terms of getting over those. So I wouldn't bother with the list. Now, if you could find hyper targeted lists for you, built for you, personalized for you, with the hook, the reason, the compelling reason why they should talk to you, why they should care about you, maybe because they've invested in the business in this space, maybe what you're doing is a gap in their portfolio. Look at their portfolio construction, look at what they're saying on the socials, give them that compelling reason. And I think that's the best way to do it. And always just bear in mind, there is one question that an investor needs to answer is, how do I turn my 500 grand, my million investment into 5 million or 10 million return? Keep that top of mind, communicate that from the get-go, and you should be able to get on top of the fold and above all of that noise.
Thank you very much, fellas. And one last thing to remember, Christina, is that family offices don't only get approached by founders, but also investors. So they can be quite sort of overwhelmed. And thank you very much, and best of luck with your venture. Please do feel free to keep joining us. We'd love to hear on your progress. Now we'll go on to Tersu. I hope I'm pronouncing your name right. I have unmuted you, and you've asked about the best stage to seek funding, which actually, you know what, they've already answered that, Tersu. So unless you have anything more specific, or if you're not happy with that, you want a bit more detail, we could go to another question. Or do you have anything more specific on that, buddy?
Yeah, I have another question. That one has been answered already.
Okay,
thank you.
Tersu, in that case, can we wait for that other question quickly if we have time? Because somebody else has put another question in the chat that I'm keen to answer, if that's all right. And then we'll see, hopefully we'll have time. Let me unmute Andrew. Where is Andrew? Allow Mike. Andrew, can you hear us?
Hi, Anton. Hi, how you doing?
How you doing? Welcome back to our stage. Quick introduction, please, Andrew, and then go with your question. And again, if I can kindly ask my panel to please keep it to a minute, I'd really appreciate it. Take it away, Andrew.
Hi there. Yeah, thanks for having me. Actually, I spoke to Tommy about this a couple of days ago, so I'm sure he's probably going to give the same answer, but I thought I'd ask it again to get some other perspectives and different opinions on it. So my name's Andrew. I'm the CEO founder of a company called Evident IME. We are developing a SaaS platform with an AI agent to bridge the gap between real-world evidence in medical education and HCP behavioral outcomes. So it's got a lot of interest. I've got a meeting with, I'm not going to name the association, but it's a billion revenue medical association, one of the largest, probably the largest if you want to Google it. But I've got a third meeting next week to discuss a £10 million LOI. And this money is going to be spent 100% on medical education, which will be meritocratically distributed amongst them key opinion leaders within their association. So the question is a negotiation tactic, and I know it might seem a little bit counterintuitive, but would it be better for, well, from an angel perspective, to have that LOI sort of, obviously it's sitting there, it's legally binding, and that money is going to be putting fuel into the SaaS platform, which is going to create the data, which eventually is the product itself. But would that LOI, if I have to negotiate and give equity away for that LOI, would that be, seeing as that cash isn't actually going into the company, it's passed through, 100% passed through, it doesn't affect the valuation of the company, would it be counterintuitively better to not have that money sit in the Evident IME company? Or, yeah, and how would that sort of be interpreted from an investor perspective?
Hang on, just to clarify, please, Andrew. Basically, that LOI is from this company saying that they would use your platform to buy the services of these people, right?
So the idea behind the actual platform itself, it's a medical education platform which allows direct to HCP funding medical education, which in the past has been non-compliant. So the existence of the platform itself relies completely on having a non-profit medical association or medical institution that can accredit medical education, and the SaaS platform is essentially just facilitating the distribution of that medical education funding.
I understood that, but what I'm trying to understand is this LOI from this large organization means that they're saying basically we're willing to be on your platform and spend money that way, right?
Yeah, well, they're sort of, they would be the association partners, and the 10 million is essentially building up the data for a year or 2 years runway, so that eventually the pharma companies that will be the clients buying the real world data and seeing the HCP behavioral insights, they would eventually be,
and they can buy that data through your platform.
Yeah, they get access to HCP behavioral insights. Yeah.
There you go. Okay. All right. Okay.
It's difficult to explain. I mean, essentially the association is putting the money in to make create the value, but eventually that, yeah.
The point I'm trying to make is, or where I'm trying to get is, you know, if they're spending money or if they're basically in any way supporting and vouching and saying that, you know, we want to engage with this platform, then that's a good thing. But let's hear what David and Rob got to say on this. David?
So I have to admit, I'm struggling to get my head around this, which, you know, investors hate complexity.
Mm-hmm.
So first of all, you're talking about an LOI. So an LOI is literally an L, right? A letter. So there's no money there. If there is a contract, in which case, and in that contract, money, you know, flows from them to you. Well, it's going to be in your business. You can have a detailed conversation about what you do with it. But I admit I am struggling to work out what the question is, what the money is. Is it? Do they have to sit there? I just don't get it. I'm sorry. And I think a lot of investors, you know, part of the problem is investors are very, very busy people, and you have to hide complexity, particularly the early stages, to get past, you know, the fact they've got so much on. So hide complexity, but I'm just not clear of what the question really is.
It's a complicated process because it's a brand new process, but traditional medical education goes through third-party medical education providers who are non-profit. What we're doing is creating a SaaS platform so pharma can sponsor medical education through the SaaS platform, which is fully compliant directly to medical professionals. The association has to be involved to accredit the content because non-profits have to accredit the content. So what they're doing is they're putting 10 million in, which will go straight through the platform to their end users, who are essentially their members. And that is sort of building up the content on the site so that you can get HCP behavioral analytics, which is the invention, which is essentially what Evident IME's invented. It's a new metric called consensus analytics, which uses
so does there have to be a cash flow? So do they have to put money into you to go into the end organization?
No, I mean, I could raise money to build the platform without that, but it's essentially it's a really massive stamp of approval because I need to work with an association.
Yeah, but can you? So it's I'm sorry, it's running out of time, and it's just not clear to me. So look, if they are paying you for a thing, great, that's wonderful, right? Because it's not SaaS revenue, but it's still revenue, right? It's still money you have in the account you can pay the bills with. So that's fabulous and definitely goes into the bank account. If there's some regulatory or industry reason why money has to flow from them through you to the end user, yeah, then I don't know. But if they're paying you for something, even if it's not SaaS, but it's a service, stick it in the main business. Just be open with your investors, what that's for, and just keep things nice and tight and open and transparent.
Sure.
Thank you very much for that, David. Rob, any thoughts on this?
I think David hit the nail on the head with the one of the first statements he made, which is simplicity is key. And my core question back to you would be, have they asked for an equity participation? If they haven't asked for it, you should never give anything away to anyone if they're not giving you something significant in return, and you wouldn't be getting that other thing in return without the equity. So that's the same for an investor. That's for granting equity to advisors. You shouldn't give it to them, they should earn it. So when you do have a share option pool for your employees, they earn it. When you have it for advisors, they should earn it. You should say, look, I'm prepared to grant you this amount of equity, but you need to earn it on a vesting schedule, and you need to demonstrate that you're actually going to continue to add value through your advice. The same is true of this potential partnership LOI. I think that you can say, if you feel like it's imperative to get the deal across the table, then you could consider having some kind of vesting schedule. But if they're not asking for it, then I wouldn't be going out of my way to offer it to them. You're still, hopefully, it sounds like, going to get them as a partner, so you don't need to offer them the equity, and you can still then invoke press releases and publicity around the partnership that you have with them as a user without giving them equity. And that comes back to the wider point, which is the people that you want to have equity in the business want to be actively involved in the business. So when you come to follow-on investors, coming back to this argument about simplicity, you don't want to have a bunch of follow-on investors going and looking at your cap table and going, why do these guys own this? What value do they actually add? Are they actively engaged in the company? Because if they're not, it will just create more problems and questions that you have to answer.
Yeah, thank you.
Thank you very much for that, Rob. Tommy, any thoughts on this?
No, I spoke to Andrew the other day, so I'll not take up any more time adding to it.
Thanks, Tommy.
Fair enough. Thank you very much. Unfortunately, we are now 1 minute over the line, and I don't want to keep the panelists longer, although I was 4 minutes late because me and my big thumbs, I guess, with technology weren't doing that great. So before I let you go, panel, any parting words? Perhaps we can start with Rob, who's unmuted, then David, and Tommy, please.
Look, I think we've covered quite a bit of ground. One final thing that I would say is that, you know, my views are subjective and only based on my lived experience. There are lots and lots and lots of people out there. There is almost an infinite tidal wave of capital out there. And to that end, for those people seeking to raise funding, keep going. Don't quit. Don't give up. Don't take no's as the end of the world. Take those failures as learnings. Ask for advice, not necessarily for capital. And, you know, stick with it and be prepared to, you know, pivot and learn from any failures and road bumps that you get along the road.
Thank you very much, Rob. David. Okay, if David's not able to, Tommy.
Yeah, just to kind of build on what was said there by Rob, I think, you know, trying to stay positive, it is difficult. I guess it was meant to be difficult raising money. And just remember the process, you know, actually going out there and how you go about raising capital is almost like a trial for a lot of investors to see, you know, how tactful and resourceful you are as an entrepreneur. So being able to show that you've been able to go out, identify the target investors, you've been able to find crafty ways to get in front of them, and you're not just sending an email into a generic inbox that, you know, 2,000 pitch decks go into every year, but you've been trying to get a contact with them and LinkedIn and engaging with their content, because to investors, that'll reflect back to them that actually, you know, this is how this person is. They are tactful, they are resourceful, and they, you know, will be able to do the same with their business to go out and find customers and get in front of people. So it is tough, but, you know, the better you get at this stuff, it's also good whenever you know, you are talking to investors and they realize what you've done and how you've gone about getting in front of them. So, you know, this stuff is also like a bit of a, you know, I guess an interview as well for what you're like as a founder. So, you know, trying to be, you know, demonstrate that's important. So yeah, just stick with it and be crafty.
Well, thank you very much. I think David might have left because I can't see him here, so he probably had to leave. But huge thanks to everyone that tuned in. Those of you that tuned in via our streams on LinkedIn, YouTube, Facebook, or Instagram, and especially those of you that were here on Microsft Teams. Of course, my appreciation goes to the panelists, Tommy, Rob, and David. Thank you very much for your brilliant advice and the time you spent with us today. Just a quick reminder to everybody before we shut shop today, we run 6 regular sessions: Monday's talent, Tuesday's product and tech, Wednesday's growth, and Thursday's fundraising, as well as 2 monthly ones. Second Friday of the month, one on UK startup law, and so legal Q&A, and third Friday of each month, a Q&A on finances. Again, they're all from 12 to 1 p.m. UK time. They're all totally free, and they all have brilliant panelists, some of the best people in our ecosystem, like the 3 fellas you heard from today. If you would like to RSVP to any of those, go to our website, startuptoscaleup.club, and I've put the link in the chat here, and just RSVP to whichever session you prefer. Or perhaps the best thing to do is to, on our site there's a link to our WhatsApp group. If you follow that, if you join that, you'll be able to get alerts for all future rooms. Remember, if you have put any questions in any of the platforms we live streamed, like LinkedIn and so on, unfortunately, we're unable to monitor your questions there. So next time, do join us live here on Microsft Teams. Apologies for the questions that we didn't have time to go through today, but please feel free to join us again. And as far as my parting words, just remember, the startup journey can be both exciting, but also quite challenging. So try to have some fun in the meantime, and be kind to yourself as well as everyone else, for that matter too. We need your help to spread the word, so please do feel free to tag and share posts about us on LinkedIn. Otherwise, have a great weekend and see you on Monday for Startup Talent Q&A. God bless you all. Bye-bye for now.